Well, hello again, everybody. Happy New Year and happy 2024. We hope your year is off to a great start. A little chilly up here in the Midwest. It certainly has been in the month of January. Well, good day. My name is Chris Kerr. I'm Chief Investment Officer with Finspire with this quarter's Focus on the Markets edition. Focusing on the new year, we're going to do a little trivia a little bit later, mixed in with some traditional resolutions. But will we see new heights or will that ball drop in 2024? I think that's really what everybody's question will be after a really strong finish to 2023. So let's get into it. All right, as usual, we're going to be mixing in a series of data-oriented charts and graphs mixed in with our opinions. And so we're looking forward to sharing those with you and really manifesting here with the Capital Market Strategy Board. So let's get into what the summary towards the end of 2023 did for our portfolios, but also what to do about it when we look forward. All right, first and foremost, the economy. The economy was really red hot in the third quarter, as you recall from a couple of videos ago. It was the Taylor Swift economy drove the third quarter GDP up close to 5%. All indications are a slowing number in the fourth quarter, which will be released next week, of economic growth. But that can be positive for us in the overall market. So if we get into a slowing economy or into an actual recession that never really materialized but could in 2024, then you could see a situation where we could continue to see growth stocks do well unless we go into a significant recession, which would push us towards the value sectors. So it's important to stay, not only to rebalance, but also to stay diversified. Also, think about in 2024, one of the underlying data points that we saw come through economically was that productivity was way above historical averages in the third quarter of last year at 4.7%. The traditional numbers, the normal average numbers are around 1.9 or 2%. And so if we continue to see productivity move higher, that means AI is really taking form and shape across and rippling through the entire parts of the economy. And that could be good to drive inflation lower. I think that's a really magic bullet. We'll talk more about inflation a little bit later. All right, markets. We hit one all-time high, believe it or not, in 2023. And it was towards the end of the fourth quarter. The S&P 500, specifically is what I'm talking about here, did hit one all-time high. It was brief before the market retreated. However, we're very close to where we were January 1st of 2022. I'll get more into that. Okay, but not all was uniform. We may be seeing opportunities in sectors that didn't do as well. Healthcare, financials, energy, and other sectors could be playing catch up in 2024. Or sometimes they're confused, or not confused, but sometimes they're mentioned as traditional value sectors. Dividend growers, right? Those all could be playing catch up in 2024, but they didn't go down as much in 2022. So I want to come to that very important point because there's a big spread between how growth stocks and value stocks perform in 2023. All right. All this being said, the fourth quarter rally was really strong. Look for the market to take a breather in the first quarter of this year. Maybe not the whole quarter, maybe not the whole half of the first half of the year, before it runs higher. And some of that could be attributable to the political environment. This is going to be like no other year in politics, probably since 1992 when we had Ross Perot as a viable third-party candidate. We're not going to have third-party candidates for president this year, most likely, but it's also a big deal in Congress. So I want to spend some more time on that, not just the whole Trump-Biden thing, because there's other things that are maybe just as important in the elections upcoming in 2024. I want to talk a little bit about tax policy as well. Tax policy that is very important. That originates in Congress, in the House specifically, and that's very important. And expect the unexpected, and that all plays into the Capital Market Strategy Board and how you're managing your portfolio, because we'll get into that throughout the presentation. All right, everything's fine, right? Let's party like it's 1999, the old Prince song, right? Is it really? Let's take a look. So I mentioned that 2023, yes, was a significantly strong year in the markets. We rebounded from a very poor 2022 environment. And yes, if you look at where we started 2022 right here, and you just move the market from where that was, look at how we ended up. This is throughout 2022. into 2023. We finished 2023 0.6% away from where we were to start 2022, which was close to very close to an all-time high in the markets. And we've been tracking this. You've probably seen this chart a few times in our videos, tracking since the COVID peak, tracking since the 2019. Market asset prices are considerably higher since 2019, since the COVID peak in February of 2020. And now we're back to close to where we were in the beginning of 2022. However, we have had economic growth since, even after inflation, although it's been filled with consternation and anxiety. We have had economic growth. So let's talk a little bit about. We'll come back to that point when we talk a little bit more about the future potential for economic growth. All right, asset classes all rising in the fourth quarter strongly, which pushed the year-end totals in 2023 much higher for the whole year. If you look at the S&P 500, up 26% in total return in 2023. International equities, very strong, plus 19. Small companies, which were really around zero, plus or minus, for the year to date as of the start of the fourth quarter, really surged in the fourth quarter to finish up 17% positive in 2023. And even fixed income, which was actually in negative territory going into the month of October, after retreating further in the first few weeks of October, surged as we finally got that pressure valve release from the Federal Reserve saying we're going to take a break or really no more interest rate hikes. And that's all the markets needed to surge higher in the fourth quarter. So even fixed income had a positive return in 2023 of close to 6%, taking balanced portfolios up around plus or minus 15%. So when you think about those diversified portfolios, it was a good year for diversified portfolios. All right. We've shown you this a few times. Leading economic indicators all still point to a negative outcome. You can see they're all below the zero line, meaning indicating that future economic contraction is ahead of us. It just has never quite fully materialized. Why is that? There's a few different methods to measure economic growth. One here is the set of leading economic indicators, which includes both financial and non-financial data points. But there's actually a division of the government called the NBER, the National Bureau of Economic Research, that designates or officially states that we're in a recession. And if you look at those two sets of indicators, they're a little bit different. And there's not too much overlap, actually, across the two. So the actual recession indicators as formed by the National Bureau of Economic, the NBER, National Bureau of Economic Research, is a little bit more weighted towards things like income, employment, and consumer spending. And those areas have all been strong despite the fact that we've had such considerable inflation. That's primarily due to the job market being as tight as it is. So will this ever result in a formal recession? Historically, it says we will, but in these current conditions, especially with the strength of the employment market, consumer spending being strong as it is, and income being generally higher than it was because of the inflation, maybe not as predictable this time around as what has been proven out over the last year. I mentioned the labor force. Labor market is very strong. We're actually back to historical averages of the labor force participation rate. Two ways to look at this. It could mean because of the inflation, the cost of living increase that we've experienced, it could mean that more people are working more than one job. And that could be factoring into this labor force participation rate. A lot of noise in labor force. We get it. Nevertheless, this is an interesting indicator that we've been tracking for quite some time, especially post-COVID when we saw the big reduction in the number of people looking for employment. All right, our first reflection of the day. This is sort of like the Deep Thoughts by Jack Handey portion of the presentation, if you all remember those Saturday Night Live skits. Analysis of the average is just average analysis. Yeah, I know, it's not my line, but nevertheless, it's something worth noting here, because when we talk about market averages, we're talking about a lot of different things happening underneath, including things like earnings. So earnings on average, right, have been gaining ground. They've been better than expected as we finished the third quarter earnings reports last year. We're just now getting the fourth quarter earnings reports come in, and the market was pricing in nearly a double-digit increase in earnings for 2024 at the end of 2023. So the market's got a long way to go. That's a tough one to earn, to hit. There's tough marks to make. But when you start thinking about things like interest rates declining and the fact that stock prices are back where they were, as I mentioned, January 1st of 2022, with economic growth, it's possible the market could get there, but that's a tough bogey to attain. But it's not uniform, right? We just talked about an analysis of the average is average analysis. If you start taking a look at sectors with opportunities, healthcare didn't do as well as, say, technology last year, for example. But when you look at earnings growth and where current valuations are for a sector like healthcare, they're pretty attractive relative to the technology. And healthcare is interesting because we had one company in particular last year, Eli Lilly, which was up over 60% in 2023, primarily due to some revolutionary drugs in diabetes care, which sort of have made their way over into the weight loss area. So they've been hot. But that's even with Eli Lilly's 60% return inside the healthcare index, the healthcare sector, I should say. But we do see other opportunities wherever you see these high levels of earnings growth, these high bars and low diamonds. Those are opportunities because earnings growth are, maybe catching up. Earnings growth is an indication of future potential for increases in those PE ratios moving forward. So it's something that by no means last year was uniform across the board. In fact, it was very disparate and tilted towards growth sectors like technology and communications. But it could be a chance here this year to broaden out the market rally that we saw in 2023, hopefully continue in 2024. But not all countries are equal either, right? This is not just a global average. We see dispersions in not just where U.S. large companies are in terms of earnings and valuations relative to, say, U.S. small companies or developed overseas countries, Japan. Again, if you have a high bar here, it means you have high earnings per share growth rates and projected, and you also in low diamonds means you have you're trading at a lower valuation, meaning it's more opportunistic. So you would think, looking at this chart, that emerging markets are demonstrating extreme value. But again, an average analysis here as an analysis of the average is average analysis because 30 to 40% of that index is China. And we know China is beating to its own path. And actually, China's economy is not growing as quickly and in some cases contracting based on conflicting reports. And that could be problematic for the emerging market countries. So it's really a good recipe for being active in not only your asset allocation, but in certain areas of global markets, being very selective in how you allocate assets in different asset classes and countries. Okay. Did you know? I did not know this. Lobsters move backwards while chickens scratch in reverse. And because of this, it's thought that eating them during New Year's Eve will bring a reversal of good luck. Well, we don't want that, right? I don't know who came up with that one, but I thought that was interesting. All right. One thing we don't want to reverse course is inflation. Okay, inflation growth has been moving in the right direction. You might hear the term disinflation. That's just a fancy word of saying inflation's not growing as fast as it once was. We've known that. We've documented that for several quarters. But as you can see here, whether it's consumer price indexes, where you have the X here, which is equivalent to the bar, top of the bar, which means we're at that trough. In other words, every month that this number moves lower, or every quarter these numbers move lower, it's good for inflation measures, and it's going to hit a new trough. And we need that to continue. But like the average analysis that we talked about earlier, consumer price components are not uniform either. So sticking points in the consumer price index continue to be transportation, things like airfare, hospitality, and shelter, okay, cost of rent. It's not growing as fast, but it's still sticking out here on these charts as being the biggest contributors to elevated levels of inflation, whereas things like medical care services, used cars, energy costs are down significantly. And so we even see that with new vehicles and apparel being held in check here with inflation figures. So this is actually good news. We are seeing things moving in the right direction. We also don't necessarily want to see a reverse course of interest rates moving back higher like they did in 2022. In fact, the short end of the curve here remains where it is. But if you look at remains high at 5 to 5.25%. But if you look at where we are, where we were, I should say, at December 31st versus where we were a quarter ago, you can see there net there wasn't much, or I should say versus a year ago, not a quarter ago, a year ago, we're back to where we were at the end of 2022. So we see markets, again, in some cases, what goes up must come down, what goes down must come up. And so the inflation rates moving higher in 2022. Now we're seeing inflation rates and inflation and interest rates drive lower in 2023. And so we're almost like the market's resetting itself back to where we were January 1st of 2022. The equity market is. The interest rate market's now reset itself to a year before, which tells us there's still a good value in bonds. And the great thing, we've looked at this a few times, even though interest rates have come down in the bond market and bond yields have fallen quite a bit in the fourth quarter, there's still good overall opportunity relative to the recent 15-year average of where bond yields are. And as we've stated, you don't even have to take a lot of risk in the bond market. In this case, investment grade U.S. corporate investment grade bonds trading at on average 5.1% yield to worst, which is above the 15-year average since 2009 of 3.6%. So still some return potential in bonds there, total return potential, not just in the yield you get, but also in the value if yields fall further, could be significant. And so we still like bonds in this environment. Okay, we all say this, right? Some form, we're all guilty of it. Have you ever heard someone who says, in my New Year's resolution, I'm not going to go to the gym anymore? Rarely, right? Exercising more, lose weight in the new year. Well, how about that resolution for Congress? What if they decided, we're going to trim the fat off the U.S. government? Oh my gosh, wouldn't that be something? But that's probably not going to happen. However, the bad news is we've been running another $1.7 trillion deficit the fiscal year end September 30th, 2023, and large deficits are still in sight in 2024 and beyond. Congress is in a jam right now, and I'll get into that more. But this is an area that really, if we could curtail spending somewhat through the U.S. Congress, it would not only help with that, keeping that inflation lower, but would be better for our overall national debt, which is eclipsing $33 trillion. More on that to come. And finally, we think this is putting pressure on the U.S. dollar, although there are a myriad of factors go into the movement of our currency. When those currencies, not just in the U.S. but around the world, start to devalue themselves due to larger deficits and more debt, investors turn to other things. Other things meaning things backed by hard assets like gold, or even investors take a look at other things like cryptocurrency as a result. So it's important that it does appear that we're off of those dollar highs that we experienced right here in especially towards the mid to end of 2022. We're off from those highs, which could be good for a globally diversified portfolio of equities and fixed income when we take a look at the portfolio ramifications and potentially for a considerable time period, because these trends in currency movements tend to last multiple years. All right, fireworks round, the not so good round, geopolitics, right? We are in a nasty section, but we're going to mix this in with a little bit of trivia. They were the first people to have the earliest recorded history of New Year's celebration 4,000 years ago. Who was it? Well, it was the Babylonians. And right now, the Babylonians, primarily in modern day, when you look at modern day Middle East, such as Iraq, Iran, and Syria, obviously a very, very volatile portion of the world, right? The Israel and Gaza war is ongoing, and no deal in sight yet for these hostages to be released. So we are very cautious about the fact that this could escalate into something much broader at any point in time. All right, hot button number 2, fireworks number 2. In this country, people celebrate the New Year by diving into a frozen lake while holding a tree trunk placed under the ice. That doesn't sound very fun. but it is Russia. Russia and Ukraine seems to be at a stalemate. We're beginning to wonder if this just will go nowhere, if unfortunately more people may die until something material changes in the world, whether it is another country that steps in, or the U.S., or somebody that says enough is enough, or some sort of truce that's drafted from the two countries. But that remains a heavy issue, not just in Russia, Ukraine, but also across Europe. Okay, let's hit another firework hotspot, the bonus round. February 10, 2024 begins the year of which of the 12 animals of the Chinese zodiac? It's actually the year of the dragon. Will begin on February 10th of 2024. China remains lurking. Recently, the Taiwanese, just this month in January, had an election for the third straight time. The Democrat Progressive Party won the election, much to Beijing's chagrin, and that could or could not saber rattle or give China another impetus to intervene in what they call reunifying Taiwan, and we're watching that as well. It's not just geopolitics globally that are creating a stir in the global economy and the global markets and with citizens around the world, but the other thing that's fascinating about what's happening in 2024, I just mentioned the Taiwanese elections that happened recently here in January. But the whole world seems to be going to the polls. 76 countries. Goldman Sachs Asset Management did some research on this, tabulated 76 countries, 4.2 billion people, which is half the global share of population. And from a market standpoint, almost 60% of the global economy is going to the polls this year to select new leaders. Now, this is fascinating because we're starting to see a bit of a trend. We saw in particular this occur beginning in Italy in 2022 with Giorgia Meloni, who became the Prime Minister of Italy in October of 2022. We saw it again with Geert Wilders in the Netherlands in November of 2023. And Javier Milei made news in December of 2023 in Argentina. What do these all have somewhat in common? Although very different, very local, all elections are local, a common underlying theme was nationalism over globalism. It really was more of an anti-globalist fervor that took the public to the polls and ushered in new leadership. Well, now we have a little bit of a documented track record here of citizens around different parts of the world, whether it be Europe, South America, going to the polls and really starting to stamp out these globalist moves and looking for results inward in their own country. Well, we're going to be doing something very similar in 2024. Why is that so important? Yes, we know the Trump-Biden 2024 general election seems like that's where we're headed this November, although it's a long way away. It seems like that's where we're headed. But I would argue, just as importantly, is the makeup of Congress. Right now, and you wonder why Congress is so dysfunctional. Yes, I know, that's a joke. It's always dysfunctional. But when you really think about why it's particularly dysfunctional today, is because of these ultra slim majorities in the House, 438 seats in the House. Only the Republicans have control of +6 with 3 vacancies. That means they can only lose 3 people in a vote. They can 2 people actually in a vote. Otherwise, they can't pass anything if they lose more than 2 people in their own party. So otherwise, everything has to be bipartisan. That's pretty tough to do right now in the House of Representatives. The Senate's up for grabs in 2024. It's Democrats +2, and from 51-49. When you look at the way everybody caucuses today in the Senate. So again, narrow majorities, and there are going to be more Democrats up for the Senate than there are Republicans this year. So you could see the Senate flip. In the House, you could also see it flip from Republican to Democrat. So you never know what's going to happen. But we're watching those races as closely as ever, and I'll tell you why. And it's because there's going to be a big battle this year, not just about the spending that we talked about earlier. Remember, government kind of needs to go on a diet and exercise this year if they could. But also the tax rates that were passed in 2017 are set to sunset or expire in 2025. And so we have seen some areas of agreement in House and Senate members getting together, working on tax bills, et cetera, to try to take what they can mutually agree upon from those 27 tax rates being reset, because those are going to sunset in 2025. And there is going to be a big battle next year when those tax rates sunset, when they approach and try to set those new rates next in the next Congress, which will be sworn in January of 2025. All right. We can't thank you enough. We're looking forward to another wonderful year working with you all. We wish you peace, health, and prosperity in 2024. And here's to learning something new for the new year. Thanks so much for tuning in. We'll see you very soon.